Your decision to hold through the crash or sell at the bottom just determined whether you preserved wealth or destroyed it. On January 30th, 2026, gold fell 11% in a single session from $5,594 to $4,145. Silver crashed 31% from $121 to $78, the worst single-day performance for silver since March 1980. Within 48 hours, both metals rebounded sharply. Gold recovered to $5,054 by February 4th. Silver surged back to $90. The traders who predicted the crash, Peter Brandt and Marko Kolanovic, reversed their positions within 72 hours. This pattern has appeared exactly twice in modern precious metals markets. October 2008, when gold fell 22% in 2 weeks and recovered 25% in the following month. And September 2011, when silver crashed 28% and rebounded 15% within 3 weeks. Both events preceded multi-year rallies that took prices far beyond the pre-crash peaks. The question is not whether this rebound is technical or fundamental. The question is whether the attempted crash that failed in 48 hours signals that selling pressure is exhausted and a larger move higher is beginning. I'm John A. and this is the Collapse Files. On January 30th, 2026, gold touched an intraday high of $5,594.82 per ounce. By the close, it had fallen to $4,145, an $849 decline, or 15.2% in a single session. Silver peaked at $121 and closed at $78, a $43 drop, or 35.5%. The magnitude exceeded all single-day moves since the 1980 Hunt Brothers collapse, when silver fell 31% on Silver Thursday, March 27, 1980. The catalyst was President Trump's nomination of Kevin Warsh as Federal Reserve Chair to replace Jerome Powell. Markets interpreted Warsh as hawkish on monetary policy, favorable to dollar strength, and resistant to political pressure for rate cuts. The dollar strengthened immediately. The dollar index rose 0.74% on January 30th, its best performance since June. A stronger dollar reduces demand for dollar-denominated commodities because they become more expensive for foreign buyers. But the price action diverged from the narrative within hours. By February 3rd, gold had recovered to $4,137. By February 4th, it reached $5,054, a $309 or 6.5% rebound in 3 trading days. Silver followed a similar path, surging from $78 to $90, a $12 or 15.4% recovery. The rebound occurred despite the dollar remaining elevated, and despite CME margin requirement increases that typically suppress prices for weeks. The margin increases on February 2nd raised requirements for gold from 6% to 8% and silver from 11% to 15%. Historical precedent suggests such increases take weeks to fully work through the system as leveraged positions unwind. The 2011 silver crash saw 5 margin increases over 8 days. Prices did not stabilize for 3 weeks. The fact that this crash reversed in 48 hours indicates buying demand overwhelmed margin-induced selling. Analysts who called the top reversed positions. Peter Brandt, a 50-year commodities veteran who accurately predicted the crash by comparing January's chart to 2011's parabolic top, stated within 72 hours, 2026 is not 2011. He suggested silver might not collapse to long-term lows as it did after the prior cycle peak. Marko Kolanovic, former JP Morgan strategist, inducted into the Institutional Investor Hall of Fame, acknowledged the move had become extreme and noted that double-digit one-day drops historically open the door to reflexive rebounds. The shift in analyst positioning matters because these individuals have no incentive to flip unless data change their assessment. Brandt's career was built on identifying major trend changes. Kolanovic spent 16 years at JP Morgan analyzing volatility and tail risk. Their reversal within days suggests the crash overshot fundamental valuations and created asymmetric risk-reward favoring longs. Physical demand provided the floor. Reports from Shenzhen, China indicated strong buying ahead of the Lunar New Year holiday, beginning February 16th. Chinese state-owned banks tightened rules on gold investment products to control volatility, but physical purchases continued. Shanghai premiums over COMEX remained elevated at 10 to 18% despite the crash. When paper prices fall but physical premiums persist or widen, it indicates the sell-off is a futures market phenomenon, disconnected from underlying demand. ETF flows confirmed the bifurcation. The iShares Silver Trust saw 8.3% gains on February 3rd, despite remaining well below pre-crash levels. The ProShares Ultra Silver ETF, a 2x leverage product that fell 62% on January 30th, rebounded 15% on February 3. These are technical moves driven by short covering and bargain hunting, but the speed of the snapback indicates that the leveraged selling that caused the crash had largely completed within 48 hours. Precious metals markets operate through three interconnected layers: physical metal, futures contracts, and financial derivatives. The physical layer includes mine production, refining, vaulting, and retail distribution. The futures layer involves COMEX and other exchanges where contracts trade. The derivatives layer encompasses ETFs, options, and over-the-counter products. Price discovery occurs primarily in the futures layer because it offers leverage and liquidity that physical markets cannot match. Leverage allows traders to control large positions with small capital. COMEX silver margins of 11% mean $10,000 controls $90,000 of exposure. When prices move favorably, gains multiply. When prices move against the position, losses compound. On January 30th, silver's 35% decline meant that a trader long at $110 with 11% margin faced a loss exceeding their initial capital. Margin calls forth liquidation. Liquidation creates selling pressure. Selling pressure drives prices lower. The cycle reinforces until leverage is purged from the system. The CME's February's second margin increase to 15% accelerated this process. Traders holding positions at 11% margins suddenly needed 15%. On a $100,000 position, that required an additional $4,000. Many traders lack the capital to meet such calls, especially after absorbing losses from January 30th. They liquidate, which drives prices lower, which triggers more margin calls on remaining positions. This death spiral can continue for weeks if selling pressure persists. The mechanics of margin calls create cascading effects through interconnected markets. When silver margins rise, traders who are simultaneously long gold, copper, or other metals face portfolio-wide capital requirements. They must choose which positions to close first. Typically, the most volatile positions are liquidated to reduce overall risk. Silver's higher volatility makes it a prime candidate for forced selling when margin pressures mount. This explains why silver fell 35% while gold dropped 15%, despite both facing similar fundamental drivers. The time compression of the liquidation also matters. Normal market corrections unfold over weeks, allowing participants to adjust positioning gradually. The January 30th crash compressed weeks of selling into hours. This creates inefficiencies where prices overshoot fundamental valuations because there is insufficient time for information to propagate and buyers to mobilize capital. The subsequent 48-hour rebound represents the market correcting this overshoot once the panic subsides and rational pricing resumes. Exchange dynamics compound these effects. COMEX operates during New York hours. Asian physical buyers operate during their business hours with minimal overlap. And when crashes occur during New York sessions, Asian buyers cannot respond immediately. By the time they assess opportunities, prices may have already reversed. This time zone arbitrage creates windows where paper markets dominate price discovery without physical market feedback. The January 30th crash occurred primarily during New York hours, limiting Asian physical market participation until the following session. But the 48-hour reversal indicates the spiral ended quickly. By February 3rd, sufficient buying emerged to absorb all selling. This suggests three possibilities. First, leveraged speculators who caused the crash had fully exited by February 2nd. Second, physical buyers stepped in aggressively at lower prices. Third, institutional buyers recognized the move as overdone and accumulated. All three likely occurred simultaneously. The entities trapped by this dynamic are short sellers and institutions with stop-loss orders. Short sellers who initiated positions at $110 for silver, expecting a decline to $80, profited on January 30th. But the February 3rd rebound to $90 erased much of that gain. If shorts covered at $90, they realized modest profits. If they held expecting further declines, they face mounting losses as prices recover. Institutions with stop-loss orders below January 30th lows face a different problem. A stop-loss at $75 for silver would have been triggered during intraday volatility, even though prices closed higher. These forced exits lock in losses without the opportunity to participate in the rebound. The speed of the reversal maximizes this whipsaw effect, transferring wealth from rule-based selling to opportunistic buying. Gold's 48-hour recovery from $4,145 to $5,054 represents a 6.5% gain. The absolute move of $309 exceeds the average weekly range for gold in 2025, which was approximately $150. Compressing a week's normal volatility into 2 days indicates abnormal buying pressure. The move occurred despite the dollar index remaining elevated at 106.8, above its January 29th level of 106.1. Normally, dollar strength suppresses gold prices. The inverse correlation broke, suggesting gold demand overpowered currency headwinds. Silver's rebound from $78 to $90 equals 15.4% in 3 days. This compares to silver's average weekly range in 2025 of approximately $8 to $10. The $12 absolute move in 48 hours exceeded a typical 2-week range. The pace suggests short covering rather than organic accumulation. When a heavily shorted asset rebounds sharply, shorts scramble to close positions, creating reflexive buying that amplifies the move. The gold to silver ratio provides additional context. On January 30th, the ratio spiked from 57 to 1 to 60 to 1 as silver fell faster than gold. By February 4th, the ratio had compressed back to 56 to 1 as silver outperformed on the rebound. The round trip in the ratio within 5 days indicates that January 30's ratio spike was a short-term dislocation rather than a structural shift. Historical ratio ranges between 50 to 1 and 80 to 1 suggest 56 to 1 remains within normal bounds. Analyst price targets reveal institutional positioning. JP Morgan raised its year-end 2026 target to $6,300, a 30% gain from February 4th prices of $4,850. Goldman Sachs maintained a $5,400 target with significant upside risk acknowledged. UBS forecasts $6,200 by March before declining to $5,900 by year-end. Bank of America targets $6,000. The consensus among major banks remains bullish despite the January 30th crash, with average targets implying 20 to 30% upside from post-crash levels. For silver, Citi raised its short-term target to $150. UBS expects $100 by March before falling to $85 by year-end. The divergence in silver forecasts reflects uncertainty about whether industrial demand or investment demand will dominate. At $90, silver trades 25% below its January 29th peak of $121, but 40% above its December 2025 level of $65. The current price sits in the middle of the range, creating ambiguity about direction. ETF Holdings data shows resilience. The iShares Silver Trust held 610 million ounces on February 4th, down from 650 million on January 29th, but above 580 million in November 2025. The 40 million ounce decline represents 6% outflows, modest compared to the 35% price decline. This indicates most ETF holders did not panic sell. Similarly, gold ETFs saw outflows of approximately 50 tons during the crash, small relative to total holdings above 3,000 tons. Central bank gold purchases provide fundamental support. The World Gold Council reported 863 tons of net purchases in 2025. Poland added 102 tons, Kazakhstan 57 tons, Brazil 43 tons. This buying continues regardless of price. When gold fell from $5,600 to $4,700, central banks did not reduce purchases. They likely accelerated, viewing lower prices as opportunities to accumulate at better valuations. The October 2008 gold crash provides the closest parallel. On October 10th, 2008, gold reached $935 per ounce. By October 24th, it had fallen to $728, a 22% decline in 2 weeks. The trigger was forced liquidation during the Lehman Brothers collapse, as investors sold gold to raise cash and meet margin calls in other markets. But within 1 month, gold rebounded to $850, recovering most losses. By December 2009, gold exceeded $1,100, surpassing the pre-crash peak and beginning a 2-year rally that would reach $1,800 by September 2011. The 2008 precedent demonstrates that sharp crashes driven by forced liquidation rather than fundamental deterioration tend to reverse quickly. The selling was technical, not strategic. Once cash demands were met and leverage was reduced, buyers returned because the underlying reasons for owning gold, currency debasement, financial system instability, had intensified rather than resolved. The crash created a buying opportunity for those with capital to deploy. The September 2011 silver crash provides another parallel. Silver peaked at $43.75 on September 6, 2011. By September 26th, it had fallen to $28.80, a 34% decline in 3 weeks. The trigger was 5 CME margin increases that raised requirements from 11% to 18%. Leveraged speculators were forced to liquidate, but silver rebounded to $35. By October 15th, a 21% recovery in 3 weeks. The rally continued sporadically until March 2012, when silver reached $37.50 before beginning a multi-year decline. The 2011 episode differs from 2008 and 2026 in an important way. The 2011 crash occurred at the end of a commodity supercycle driven by Chinese infrastructure demand. The rebound was temporary. Prices ultimately fell to $14 by December 2015. The question is whether 2026 resembles 2008 or 2011. The answer depends on whether underlying drivers remain intact. In 2008, underlying drivers intensified. The financial crisis expanded. Central banks implemented unprecedented quantitative easing. Budget deficits exploded. Gold's subsequent rally reflected these realities. In 2011, underlying drivers reversed. Chinese growth slowed. Commodity demand peaked. The Federal Reserve began tapering QE, the dollar strengthened. Silver's subsequent decline reflected these shifts. In 2026, underlying drivers appear more similar to 2008 than 2011. The U.S. debt exceeds $36 trillion. Interest expense approaches $1.2 trillion annually. Central banks accumulated 863 tons of gold in 2025, despite record prices. The dollar's reserve share declined from 58 to 57%. These trends suggest structural support for gold remains intact. The policy environment also mirrors 2008 more than 2011. In 2008, the Federal Reserve implemented emergency measures and expanded its balance sheet from $900 billion to $2.2 trillion within months. The precedent was set that authorities would intervene aggressively during crises. In 2011, the Fed had begun tapering asset purchases and signaling normalization. Markets anticipated tighter policy, which suppressed commodity prices. In 2026, the policy environment remains accommodative despite Warsh's nomination. The Federal Reserve's balance sheet exceeds $7 trillion. Fiscal deficits approach $2 trillion annually. Real interest rates, adjusted for inflation, remain near zero or negative. These conditions historically support precious metals because they reduce the opportunity cost of holding non-yielding assets. If Warsh pursues genuinely restrictive policy with positive real rates above 2%, the analogy to 2011 becomes valid. If he maintains accommodation despite hawkish rhetoric, the analogy to 2008 holds. The emerging market context also matters. In 2011, China was tightening monetary policy to combat inflation, reducing commodity demand globally. In 2026, China is easing policy to support growth, potentially increasing commodity demand. The shift in Chinese policy stance alone creates a different macro backdrop that favors continued precious metals strength rather than the multi-year decline that followed 2011. The mainstream narrative frames the January 30th crash as a response to Warsh's nomination and implies the rebound is a technical bounce before further declines. This misses the signal embedded in the speed of the reversal. When a market crashes 35% and recovers 15% within 48 hours, it indicates the crash was a liquidity event rather than a repricing of fundamentals. Liquidity events reverse quickly once selling pressure exhausts. Fundamental repricings take months to unfold. The analyst reversals also carry information. Brandt and Kolanovic built reputations on accurate macro calls. Their bearish positioning ahead of January 30th was correct. Their reversal within 72 hours was not capitulation. It was recognition that the trade had worked and risk-reward had inverted. When skilled traders close winning positions and reverse, it signals that the move is complete and a new phase is beginning. The physical paper divergence provides additional evidence. Shanghai premiums of 10 to 18% over COMEX persisted through the crash. If the crash reflected fundamental repricing of gold's value, Shanghai buyers would have reduced bids. Instead, they maintained or increased premiums, indicating they viewed COMEX prices as technical dislocations. Chinese buyers were willing to pay $4,900 when New York priced gold at $4,700. This arbitrage should not exist if both markets are pricing the same asset based on the same fundamentals. The second-order effect involves positioning for what comes next. The crash purged weak hands and over-leveraged speculators. The remaining holders are more likely to be strategic buyers with longer time horizons and stronger balance sheets. This creates a more stable base for future rallies. When the marginal holder changes from leveraged speculators to strategic accumulators, volatility decreases and uptrends become more sustainable. Media framing also matters. Headlines emphasizing the crash and ignoring the rebound create psychological anchors that suppress participation. Investors who read "silver crashes 31% are less likely to buy than those who read "silver rebounds 15% in 48 hours. The asymmetry in coverage reinforces recency bias and prevents capital from re-entering the market even when risk-reward has improved. The retail investor psychology deserves attention. Many retail participants entered precious metals during the 2025 rally at prices above $4,500 for gold and $90 for silver. When prices crashed below their entry points, panic selling dominated, but those who sold at $4,700 after buying at $5,000 locked in 6% losses. Those who held through the crash and participated in the rebound reduced losses to break-even or modest declines. The lesson is that volatility punishes panic and rewards patience. The options market provides additional signals. Put-call ratios for gold and silver spiked during the crash as investors bought downside protection, but implied volatility collapsed during the rebound, indicating fear had subsided. When volatility mean reverts quickly after extreme events, it suggests the market has returned to equilibrium rather than entering a new crisis phase. The rapid normalization of volatility following January 30th supports the thesis that the crash was an isolated liquidity event rather than the beginning of a prolonged bear market. The correlation breakdown between gold and real interest rates also carries information. Historically, gold moves inversely to real rates. When real rates rise, gold falls because the opportunity cost of holding non-yielding assets increases. But during and after the January 30th crash, real rates remained stable while gold exhibited wild swings. This suggests that the price action was driven by technical factors, margin calls, forced liquidation, short covering, rather than changes in fundamental drivers like interest rates or inflation expectations. The failed crash in 48 hours signals that selling pressure is exhausted and the market has transitioned from liquidation to accumulation. This matters because the next move higher will occur from a higher base with less leverage and more strategic positioning. The January 29th peak of $5,594 for gold and $121 for silver represented overextended, leveraged speculative positioning. When those levels are eventually exceeded, it will reflect fundamental demand rather than speculation. The institutional price targets ranging from $5,400 to $6,300 for gold indicate consensus that the January 30th crash did not change the bull market structure. Banks do not maintain bullish targets through crashes unless they believe fundamentals remain supportive. The fact that targets were raised in some cases suggests institutions view the crash as a buying opportunity rather than a trend change. What breaks first historically is confidence in the ability to crash prices through coordinated selling. The January 30th event demonstrated that even a 35% decline in silver and 15% decline in gold cannot be sustained if physical buyers step in aggressively. Future attempts to crash prices will be met with increasing physical demand at lower levels, creating natural floors. This is the death of price manipulation through paper market selling. The trust dimension operates at multiple levels. Investors trust that precious metals will preserve purchasing power during currency instability. The January 30th crash tested that trust. The 48-hour rebound confirmed it. When gold and silver demonstrate resilience by recovering quickly from large declines, it reinforces the narrative that they are reliable stores of value. This attracts additional buyers, creating positive feedback loops. The geopolitical aspect involves the weaponization of markets. If the January 30th crash was engineered through margin increases and coordinated futures selling, the rapid reversal indicates the tactic failed. Future geopolitical actors attempting to suppress precious metals prices will recognize that physical demand from Asia, central banks, and strategic buyers overwhelms paper market manipulation. This could accelerate the shift from Western paper markets to Eastern physical markets as the dominant price-setting mechanism. On January 30th, 2026, gold crashed 15% to $4,145, and silver fell 35% to $78. The worst single-day move for silver since 1980. Within 48 hours, gold rebounded to $5,054 and silver to $90. Analysts who predicted the crash reversed their positions. Physical demand from China remained strong. ETF outflows were modest. Central bank buying continued. The attempted crash failed. This pattern has appeared twice before, October 2008 and September 2011. In 2008, the rebound preceded a multi-year rally that doubled prices. In 2011, the rebound was temporary before a multi-year decline. The difference was underlying fundamentals. In 2008, drivers intensified. In 2011, drivers reversed. In 2026, drivers appear to remain intact with U.S. debt at $36 trillion, central banks buying 863 tons, and the dollar's reserve share declining. Institutional price targets average $5,700 to $6,100 for gold and $100 to $150 for silver over the next 6 to 12 months. These targets imply 20 to 30% upside from current levels. The targets were maintained or raised following the crash, indicating banks view the event as a temporary setback rather than a structural break. The signal is clear. When a market crashes violently and recovers quickly, it indicates selling pressure is exhausted. When analysts who called the top reverse within 72 hours, it indicates the trade is complete. When physical premiums persist through paper market crashes, it indicates price discovery is migrating from west to east. When central banks continue buying regardless of price, it indicates strategic accumulation dominates speculation. The 48-hour reversal does not guarantee that new all-time highs are imminent. Markets can consolidate for weeks or months after violent moves, but it does indicate that the downside risk has been tested and found limited. Physical buyers emerged at $4,700 for gold and $78 for silver. Those levels now represent strong support unless fundamentals change dramatically. For those positioned long through the crash, the decision to hold rather than sell at the bottom has been validated by the rebound. For those who sold during panic, the rapid recovery represents a missed opportunity. For those who bought at the lows, the 6 to 15% gains in 48 hours represent significant profits. The market has rewarded patience and punished panic. This is not financial advice. This is observation of price action and positioning. The crash that failed in 48 hours tells us more about market structure than the crash itself. It reveals that physical demand overwhelms paper selling, that strategic buyers accumulate during panic, and that leverage-driven crashes reverse quickly once liquidation completes. The next move higher, whenever it comes, will be built on a more stable foundation with fewer weak hands and more strategic conviction.